Think about the last time you rented a car or an apartment. You willingly paid a temporary fee to use something you didn't own, and then eventually you gave it back. You can do the exact same thing with physical cash. When you borrow money, you pay a specific fee to rent those dollars. We call that fee the interest rate, and it works as a two-way street. If you take out a loan, you pay rent to the bank. But if you keep your savings in a bank account, the bank is actually renting your money, and they pay you an interest rate for the privilege. Local banks don't decide the base price of that rent. That job belongs to a central landlord, a central bank, like the Federal Reserve here in the United States. So why does this central landlord constantly change the rent on money? And how can altering that single percentage point change the way millions of people spend and save? The interest rate acts as the master control dial for almost all human economic activity. Imagine this central bank decides to put money on clearance. They deliberately lower the interest rate, making cash cheap to rent. The first domino to fall is housing. Mortgages become highly affordable, which prompts a rush of people trying to buy homes all at the exact same time. Since there are only so many houses built in a given year, this sudden surge of buyers competing for limited property naturally drives housing prices up. The second domino falls in the corporate world. Business loans also become cheap, making it easy for companies to borrow large sums of money. Companies use that money to expand. They construct new facilities, buy more equipment, and hire hundreds of new workers to keep up with their growth. By keeping the rent on money low, the central bank triggers a society-wide hiring and buying boom, stimulating rapid economic growth. But this boom creates a friction point. Everyone has cash. Employment is high, and people are rushing the stores trying to buy things simultaneously. Despite all that spending power, there is still a strictly limited number of physical goods sitting in warehouses. Because the amount of money outweighs the available goods, businesses realize they can and must raise their prices to balance the scales. This scenario, where prices rise across the board because consumer demand outpaces physical supply, is called inflation. You see it every time your grocery store bill ticks higher for the same items. So, while rapid economic growth feels good initially, runaway inflation destroys the actual purchasing power of the money people are renting. So, how does the central bank fix an economy that is overheating and causing rampant inflation? They implement a necessary solution. They raise interest rates, making money highly expensive to rent. Instantly, the dominoes fall in reverse. Mortgages become too expensive for the average family to afford, causing people to stop buying houses. On the corporate side, business loans become too costly to justify. Companies are forced to cancel factory projects and freeze their hiring. As people lose their excess spending power, businesses are forced to stop raising prices just to attract whatever few customers are left. Making money expensive to rent is a deliberate tool. It forces the economy to slow down, which starves and suffocates inflation. These global shifts are decided by a small group of people sitting around a table, trying to find a mathematical balance. Think of the economy as a car. Low interest rates are the gas pedal used to accelerate growth, and high rates are the heavy brakes used to stop inflation. The inherent paradox is the driver cannot press both at the exact same time. These small percentage tweaks determine the price of a mortgage, a company's hiring budget, and the cost of groceries. When a headline announces the central bank is raising rates, you'll know exactly what's happening. The landlord is just raising the rent on money to cool down an overheating world.
Share, like, comment, and subscribe.